$20 doesn't feel like much. It comes and goes, coffee here, delivery there. But what if I told you that that same amount, when invested in a carefully selected portfolio, could generate over $7,000 in monthly dividend income? Sounds too good to be true? Well, in this video, I'll show you how to make it happen. I'll show you and John how to select specific stocks for this target. I'll show you the secret to dividend investing. And in the end, I'll show you how a portfolio of these stocks can turn a $20 a week investment into an $800,000 portfolio that'll pay you over $7,000 in monthly dividend income. But first, let's take a step back and understand the concept. Let's start with the basics, because if you're going to build your future around dividend investing, it needs to make sense right from the start. A dividend is essentially your slice of a company's profits. When you own shares in a business that pays dividends, they send you a portion of their earnings just for holding on to their stock. No selling, no trading, no extra effort. That's what a dividend stock does. It puts money in your pocket simply for being an owner. Now, some people buy stocks hoping the price will skyrocket. That's called capital appreciation. And while it can be exciting, it's unpredictable. Dividend investing flips the mindset. Instead of hoping your stock jumps in price, you're building a portfolio designed to pay you regularly and reliably, regardless of what the market's doing. That money can be used however you want. Reinvest it, pay bills, fund your lifestyle. Over time, as you add more shares and companies grow their payouts, those dividend checks can grow from a trickle into a river. Dividend investing isn't just about getting rich, it's about creating cash flow. It's about turning your money into a quiet worker that sends you income every single month, even while you sleep. And the best part, anyone can do it. You don't need thousands of dollars to start, just the right approach, the right stocks, and a bit of patience. Now, when it comes to dividend investing, there are two main strategies: dividend reinvestment plans, or DRIP, and non-DRIP investments. To reach the $7,000 per month income with only a $20 a week contribution, you need to know how this works. Let's start with what happens when you don't reinvest your dividends. This is what's called a non-DRIP investment. Here's how it works. When you own shares in a company that pays dividends, they'll send you cash regularly, usually every few months. That money shows up right in your account, and you can do whatever you want with it. Spend it, save it, or put it somewhere else. It's your call. Now let's say you invest $1,000 in a stock that pays a 5% dividend. That means you'll earn $50 per year in dividend income. But if you just take that $50 in cash and don't reinvest it, your investment stays right at $1,000. And every year, as long as the company keeps paying the same dividend, you'll keep getting that same $50. It's consistent, but it doesn't grow on its own. Now let's look at the DRIP strategy, which stands for Dividend Reinvestment Plan. And this is where the real magic starts. With DRIP, instead of taking your dividend payments as cash, those payments automatically get used to buy more shares of the same stock. So say you invest $1,000 into a stock that costs $20 per share. That means you now own 50 shares. Like before, let's say that stock pays a 5% dividend, which comes out to $50 a year based on your $1,000 investment. If you choose DRIP, the Dividend Reinvestment Plan, here's what happens with those dividends. In year one, instead of pocketing that $50, it automatically gets used to buy more of the same stock. Since each share is $20, your $50 buys you 2.5 more shares. So now you own 52.5 shares. So in year two, your dividends aren't based on 50 shares anymore, they're based on 52.5 shares. And you now earn around $52.50 in dividends. That buys you 2.6 more shares, bringing you up to 55.1 shares, which means by year three, you're now earning dividends on 55.1 shares, which gives you about $55.10. That buys you roughly 2.75 more shares, bringing your total up to 57.85 shares. So in just 3 years, your share count has gone from 50 to nearly 58 without you adding a single extra dollar from your pocket. And that's with just a steady 5% dividend and no change in the stock price. Now imagine that same effect continuing every single year, and on top of that, if the stock price goes up, or if the company increases its dividend, which many good companies do, that snowball starts rolling even faster. This is how DRIP works. Your money earns more money, which buys more shares, which earn even more money. It's slow at first, yes, but give it time, and it turns into something really powerful. Now, let's see these strategies in a side-by-side comparison. Let's look at the dividend income alone over these 3 years. In the non-DRIP path, you collected $150 total, $50 a year, plain and simple. But with DRIP, by reinvesting your dividends every year, your annual payouts started to rise. By the end of year 3, you'd earned $157.60 in total dividends. That's about $7.60 more than the non-DRIP route. Now sure, that might not seem like a big deal yet, but remember, this is just 3 years. That extra $7.60 didn't come from you adding more money, it came from the shares your dividends purchased in previous years. And guess what? Those new shares are going to keep paying dividends too, which will buy even more shares, and so on. The longer you let this cycle run, the bigger the gap becomes. It starts slow, but over 10, 20, or 30 years, that snowflake turns into a snowball of passive income. I'm talking tens of thousands of dollars more, all because you chose DRIP from day one. And this is the secret to dividend investing. So now that you understand how DRIP turns passive income into exponential growth, let's look into how to pick the right stocks that'll help you reach your income goals. This strategy is built on consistency, so I used a very specific set of filters that favor long-term reliability, growing income, and steady appreciation. The first thing I looked at was the dividend yield, basically how much cash you get back every year from your investment. A strong yield means your money is already working to generate income. But a high yield by itself doesn't tell the whole story. Sometimes high yields are red flags, like the company's in trouble and trying to attract investors. That's why the second metric, dividend growth rate, was even more important. I focused on companies with a proven track record of increasing their payouts year after year. Think of this like giving yourself a raise every 12 months without having to ask for one. The higher and more consistent the growth, the faster your income compounds. Then I looked at the share price appreciation. While our focus is income, we still want our investments to grow in value. Strong capital appreciation increases your overall wealth and boosts the effect of reinvested dividends. But beyond the numbers, I also considered business strength and industry leadership, consistently profitable companies that have been operating for decades with a strong brand or market position. These are the ones we wanted. And finally, I focused on diversification. I didn't pick all high-yield stocks or all high-growth companies, I combined both. The goal was a portfolio that pays well now and grows like crazy over time. Next, I'll show you how I selected the stocks based on this exact criteria, and then I'll show you how the portfolio I built can turn a $20 a week investment into an $800,000 portfolio that pays you over $7,000 a month in dividend income. But first, the stocks I selected. Based on the criteria, the following 5 stocks have been carefully chosen for their ability to generate reliable income as well as their potential for long-term growth. Each one plays a unique role in building a portfolio that works quietly in the background, compounding your money into something powerful. Let's start with Extra Space Storage, with the ticker symbol EXR. This company is the largest operator of self-storage properties in the U.S. Based in Utah, EXR owns or manages over 4,000 storage locations in 43 states. What makes this business attractive is its durability. People always need storage. Whether they're moving, downsizing, or running a small business, self-storage demand is consistent. EXR has a 4.38% dividend yield, has grown those dividends by 12.47% on average each year over the past decade. And on top of that, the stock itself has appreciated by 7.74% per year. Next, Lowe's Companies with the ticker symbol LOW. This retail giant has been around since 1921 and has become a go-to for home improvement needs. From lumber to lighting to landscaping, Lowe's supports both DIY homeowners and professional contractors. What I love about Lowe's is that home improvement isn't a trend, it's a lifelong need. As homes age, as families grow, as people stay put, instead of moving, they invest in where they live. Lowe brings a 2.19% dividend yield, a remarkable 17.46% 10-year dividend growth rate, and 12.68% annual share price appreciation, making it a long-term wealth builder. On to the next stock, NetEase with the ticker symbol NTES. Based in China, NetEase is a tech conglomerate with global reach. It operates in online gaming, music streaming, educational tech, and smart devices. This multi-pronged business model brings both innovation and diversification. NTES pays a 2.03% dividend yield, shows a massive 24.79% dividend growth rate, and offers 16.25% in annual share price appreciation. It's my high-growth pick, helping supercharge long-term results while adding some international exposure. Fourth is the Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. This is the core stabilizer. SCHD holds a basket of top-performing U.S. dividend stocks, all vetted for strong financials and consistency. With SCHD, you get instant diversification across major industries without needing to buy 100 different individual stocks. It pays a 3.79% dividend yield, grows dividends at 10.77%, and has an annual share price appreciation of 7.64%. For investors who prefer something hands-off, SCHD is the ideal foundation. Lastly, Kroger with the ticker symbol KR. This grocery and pharmacy giant has been in business since 1883. It operates thousands of stores and fuel stations, providing everyday essentials to millions. In good times and bad, people buy groceries, which makes KR a low-volatility, recession-resistant stock. It pays a 1.96% dividend yield, has shown 13.52% dividend growth, and an annual share price appreciation of 6.71%. Kroger keeps the portfolio grounded while still delivering growth. So now that we have 5 stocks selected, the next step is to calculate our portfolio dividend yield, dividend growth, and price appreciation. And it's fairly simple to do this. Let's start with dividend yield. Each stock in your portfolio pays out a certain percentage of its value in dividends every year. To figure out the average dividend yield across all 5 stocks in our portfolio, you simply take each stock's dividend yield, add them together, and divide by 5. For example, EXR currently pays a 4.38% dividend yield. Lowe pays 2.19%, NTES is at 2.03%, SCHD pays 3.79%, and KR pays 1.96%. To get the average dividend yield of the whole portfolio, you simply add those numbers together and divide by 5. So that's 4.38 plus 2.19 plus 2.03 plus 3.79 plus 1.96, which adds up to 14.35%. Divide that by 5, and you get our portfolio dividend yield of 2.87%. You can follow the exact same steps to calculate dividend growth, which is the rate at which those dividends have increased over the past decade. Add up the 10-year dividend growth rates for all 5 companies, divide by 5, and you get the portfolio's average dividend growth, which for this portfolio is 15.8%. Do the same for the average share price appreciation, and we get 10.2% for the portfolio. This combination gives you a portfolio that works in 3 dimensions: paying you now, growing your income over time, and building wealth through appreciation. So what does this actually mean for your money? Let's say you stay consistent and invest $20 a week in this portfolio over time. After 1 year, you would have saved up $1,040. This sets the stage for future investment and growth. After 5 years, your weekly contribution along with capital appreciation and dividend reinvestments will be valued at $6,817. In 10 years, your portfolio would grow to $20,326. Give it 10 more years, and your investment after 20 years will be valued at $117,813. This is when the compounding effect takes full effect, and after 30 years, your portfolio would be valued at $837,511. At the same time, you'd be receiving $93,905 per year in dividends, or around $7,825 per month, just from your $20 per week investment. The total value added to your portfolio would be $806,311, with $385,426 coming from capital appreciation and $420,886 from dividend reinvestment. Want to get paid every week starting next week? Click the video on the screen to find out how.